In this video, traders, we're going to break down what's a good percentage target to aim for as a trader. Stay tuned. Hey guys, warm welcome to you. All right, so this is a common question. It's something we think about a lot. What's a good percentage target to aim for as a trader? Now, ultimately there are some big extremes out there, guys. There are people who have turned a very small pot into a very big pot. And equally, there are guys who've got a very big pot and who are not making much on it. If we look on the profit side of things, of course, we know there are people who are losing, but forget about that for now. But what's a kind of reasonable assumption to make, and what sort of things is the accepted level for traders? Let's break some stuff down and look. Well, first of all, I want to just say this, that trading really is using capital as a tool. I'm not the biggest fan of looking at things in percentage returns, because sometimes, especially as a kind of an active trader, you look at how much capital you've used versus how much capital you've made in a given portion, and the number looks silly. It's like multiple hundreds, thousands of percent, and you think, well, it's not really relevant because I've used it as a tool and I put nearly all that money at risk each time I've made a trade, or initially I used a lot of it as margin, so it doesn't really count. You know, turning in 2 grand into 200, maybe you've got a bigger pot but you only use 2, you kind of can skew the numbers a bit. So I'm cautious about using percentage, but with that in mind, let's have a look at some things in the broader picture of things. So one thing to say, guys, if you're actively trading, you want to be compensated, right? You want to be actively and compensated well for what you're doing. Because just from a scan on FinViz, literally before I did this video, there are 232 stocks that have got a greater than 10% dividend. So in theory, and I know this is very, very loose and there's lots of things to be concerned about there, in theory, you pick some of those better stocks, you could get 10% or a little bit less from doing nothing, still having your capital at risk. Yes, but your capital's still at risk with trading, but without any input from you. So as traders active traders with input in the market and decision making, then we are going to want to be rewarded higher, much higher than if we're passively investing in something. So let's look at some numbers. So imagine if you've got a £100,000 account. It's just for ease of calculation. It could be 10, could be 1, could be a million. It doesn't matter for calculation purposes. And let's look at kind of some textbook models of, you know what, we need to only risk 2%. And we've done videos on that where, you know, my thoughts on that are, it sometimes doesn't work for you. If you've got a smaller account, that doesn't really work. You're never going to get off the ground, so sometimes you've got to put more risk on the table. But let's just use this thing that's banded around a lot and 2% risk and say, okay, 2% risk on a per trade basis with a 100 grand account is 2 grand, okay? And let's say we've got a risk reward ratio of 3 to 1. I'm going to do 2 to 1 as well, but let's just say 3 to 1 because that's the kind of thing that we would expect as traders. We're looking to make 3 times our risk. 3R would be a reasonable, it's not excessive, it's not small, it's about right. And just to make the assumption that we're right 50% of the time. So we're not looking for extreme stuff, we're not looking for kind of 60s, 70s, 80s. We've got a decent risk reward ratio and a 50-50 chance of success. All seems relatively normal and achievable, right? So we have a scenario now where we're risking 2 grand. And if we make our profit, we're going to make 6 grand. That's the kind of numbers we've got here in the 50% of the time. So if we took 10 trades, 5 of them are going to be losers, 5 of them are going to be winners. This is that 50-50 rule that we've kind of put in place for ourselves. So our 5 losers is going to be 2 grand times a 5, which is 10 grand. But our 5 winners, we've got 6 times 5, £30,000. So we've got a net over those 10 trades of 30,000 minus the 10, which is £20,000, right? So 20 grand we've got in place or profit over those 10 trades. And if you can imagine, if we're swing trading or if we're kind of a little bit more active, we maybe do 5 trades a month, which isn't a lot of trades, okay? And that's would be 10 grand a month, right? Because over 10 trades we make 20 grand, so 5 trades we make 10 grand. So over the year it's 120k per annum, which when we look at our 100 grand, even if we allowed for some drawdown, some of this, we're talking about 100% plus return on our investment, right? Let's assume that we had some sort of drawdown in there, which happens times we weren't trading, times we weren't on form, and assume that that was only 100,000, then we're still doubling our money in the year, which is kind of ballpark we want to be in. Now, if we flip that on its head and say, well, even if our risk reward ratio was 2 to 1 and we're still operating under this 50% rule and we're operating under a not stupidly high frequency trading either, even that, would give us a 10 grand profit on these numbers here. 10 trades, 5 losers, 5 winners, a 2 to 1 would give us 10 grand profit. So even if we did that over the period of time, we're looking at, even if we did 10 trades and we upped our trades, for example, and we're kind of a bit more active, we're still looking at the same sort of numbers. Even 50 grand is 50%, but 100% is really what I believe the kind of minimum that it really does depend obviously on the pot size you've got, right? I recognize that if you've got a smaller pot, then you're going to have to look for maybe more on it, because you're going to have to risk a little bit more in risk reward ratio. If you've got 10 million, then you're probably not going to want to risk 200,000 on each trade. So I recognize it's relative, but if you look at the numbers and break it down, doubling your money isn't a big thing. Now, of course, some bright guy's going to go, well, if you double your money every year, you're going to be richer than Warren Buffett by the time this does that. I get it. This isn't always a linear thing. You're not always going to double your money every year. 100 grand, 200 grand, 400 grand, 800 grand, 1.6. It doesn't work like that. If it did, it would be fantastic, but it doesn't work like that. We go through spells of drawdown. We go through spells of taking money out for other things, but there are obviously traders, investors out there who are doing that. I mean, if you look at Warren Buffett, for example, he has grown massively, but there is a point obviously where you can't just be doubling your money every year. But if you're talking of this order of magnitude, the point of the video is to say, okay, I think if you're actively trading and you're exchanging your time to be in front of the screens, then you want to be rewarded in this order of magnitude, i.e. 100%, i.e. that kind of level. To be trading and trying to make 10% doesn't seem to be a worthwhile exchange of money, right? To make 10 grand on your 100 grand when your capital is seriously at risk, even if you're risking 2 grand per trade, it's still seriously at risk, right? So it doesn't mean that use kind of a safe way of making money. You could trade the same thing with your capital at risk, and okay, this is a broad kind of search, but there are plenty of stocks out there that are giving you a 10% dividend. There's probably plenty of other things that are lower risk for your capital that are giving you less of a payout, but are still much, much safer than trading. So the point is, guys, if you're going to be actively trading, look at the numbers, work it all out for yourself. Look at your numbers yourself. What's your risk reward ratio expectation? What's your probability expectation? All these kind of things. See the amount of capital you've got and see where you could be and where you could be if it didn't go wrong. And then look at those things and say, well, am I happy with those? Will it work out for me? And if it's yes, then you're good. Anyway, guys, that's a good percentage target to aim for as a trader. Maybe I should reframe that and say, watch the expected. A good, you'd want to be looking for serious numbers, and there's guys out there who have put in serious numbers, but that's not to say you're going to put serious 1000% years in every year, 500% years in every year, but it does happen. But then next year might be stagnant. But that's trading, guys. That's the approach. But anyway, that's a broad look at it. If that's helped, give it a thumbs up. Take care. See you next one. Bye bye.